All right, what's going on, folks? Welcome back. It's been a while since I've done a stream on this channel. Normally, these days, me and Kyle from Passive Income Investor are doing streams on our normal channel now. So we have a secondary channel where him and I do most of our streams. And so that's where I've been doing a lot of those. And the reason being is because I feel like a lot of the streams on here were somewhat, I guess, distracting away from some of the main content. And also some folks didn't really like the constant reminders of streams kind of coming online, because it sends out a 30-minute update beforehand and then it tells you when it's live. And so some folks didn't like that. And so they immediately, would unsubscribe to the channel. So that's why we kind of created that secondary channel. And also it goes a little bit along with some of the brands that me and Kyle are trying to create. So for some of you guys that may or may not know, we own 3 different websites at this point. So we have spacstock.com, which I'll show you in just a second, chartmaster.com as well. We also have Passive Income Educator website. So all those are kind of really rolled up into that new channel that we're kind of doing. So if you guys are interested in checking out the new channel, feel free to hop on to the description down below where we're actually highlighting a lot of that stuff. And actually touching a little bit more on it. So actually, if you want, I can just do a quick screen share of that relatively quickly. And so that way you guys can kind of see what it actually looks like. So this is the other secondary live stream channel. So if you guys are interested in checking that out, feel free to do so and make sure you subscribe to that channel as well. Just because that's where we do our live streams every Friday night. So if you guys are interested, Independent Investor also does a live stream on Friday nights at about 9 p.m. And then after that, he, generally speaking, puts up a phenomenal show. I always learn a whole lot when I go onto his show and listen. And after that hour, me and Kyle go on from about 10 to 11. Sometimes we do some pretty radical stuff. We generally do giveaways every Friday as well. I think we've given away over $100 over the past month, and we also plan on doing a lot more once we start hitting some more milestones with the channel as well. So if you guys are interested in seeing that, feel free to do that. This is spacstock.com. It'll look a little bit different for you guys if you guys end up going to it. But if you guys are interested in SPAC stocks, which are basically blank check companies that help take other companies public, this is where Kyle and I have kind of been putting some effort into as well. Mostly Kyle. I've done some blog posts on here as well, but be able to put some things together to kind of give you guys an idea as to what some of these SPAC stocks are really trying to do. And then, of course, a lot of you guys are probably already familiar with the chartmaster.com, where we put together some of our Excel tools, like our Google spreadsheet tracker, where you can kind of track your portfolio. And then we also have some other things like there's another one we just kind of put on here as well, if I remember correctly, which is like a fire tool calculator for like a couple bucks. I don't even remember what it is, but basically allows you to understand how much you really need to save over time and how quickly you'd be able to kind of retire. And that one's been doing okay. That one's been selling a little bit as well, but I think that one hasn't really been advertised nearly as much as some of the other ones. So if you guys are interested in that. And then, of course, Kyle and I also offer private kind of coaching and tutoring if you guys are interested. We also have some one-on-one sessions as well as individual courses. But of course, if you guys want, we have WhatsApp group, Discord chats, and the giveaways that we always give away. So if you guys are interested, just feel free to look at our lifetime access pass and our 3-month subscription as well. And I think that those are actually going to end up going up in terms of price in the near future as well. So really just wanted to kick it off with that for those of the guys that are really not really sure what the hell I'm doing with some of my time. And I know I've been a little bit hesitant on doing more content as well. But anyway, hopping into more of the portfolio side of things. So this year has been wild, man. I mean, not just from the pandemic standpoint, but just being able to grow the portfolio as much as I have has been phenomenal. I remember, I think stepping into the country here in Trinidad and Tobago, I don't even think I had $100,000 or $300,000 in the portfolio as yet. And now I'm over 540,000 depending on the day. And so, I mean, that's pretty substantial amount of income that can come from that portfolio, and a lot of opportunity and a lot of optionality kind of coming from that portfolio. Because of course, while it currently is in stocks, you can transfer that into, say, real estate or another business where you can start generating cash flow from that. So for a 12-month income, for those of you guys that don't know a lot about the portfolio, is just under $16,000 a year. And I'm hoping to increase that to $21,000 for 2021. Current goal for 2020 is $14,000 in year. I think we're at estimating about $13,900 for the year. So I have $100 or so that I need to kind of come out of somewhere, whether that's through further investment or what, to be able to get $14,000 in dividend income in 2020. And then also with some of the website income and options and YouTube, obviously, we're looking at about close to $26,000 overall. So that's inclusive of that $14,000 sort of dividend goal that we'll be getting this year. So relatively awesome. Last year, to give you guys perspective, I think we closed 2019 with $10,900 in total income. That was from YouTube, that was from dividends. And so the fact that we're going to be trying to get close to 26,000 is pretty astonishing. It's like 150% increase year over year. And so a lot of that had to do with the website income. A lot of that had to do with starting up options, both of which were options weren't even started in 2019, but the website income is something that really started coming into its own in 2020. I did have some website income last year, but it was just so small that it wasn't even worth even really looking at. I think I was still losing money because I still had to pay the hosting fees and stuff like that. So, but anyway, that's a nice little, I guess, overview and I guess a culmination from the past 7 years worth of work, kind of starting back in the 2013 timeframe to now, and really just starting to get to somewhere where I feel relatively confident with what I'm doing and that the strategy is working. And something as simple as seeing, I think it was like $8,500 or $8,600 in dividend income last year in 2019 to now be able to close in on $14,000 in a year. I mean, that's a pretty substantial amount of increase year over year. And if I can continue that sort of increase, that 50-60% year over year increase, that's just going to be absolutely phenomenal. I'd be excited going forward for the next 10-20 years at 20% year over year increases in dividend income on a $14,000 sort of income stream coming from dividends. But of course, if I'm able to keep it up at, say, 30, 40, 50% over the next couple of years, that's just going to be skyrocketing in terms of value. But you start thinking about some of the awesomeness and the optionality that really comes from that. So take something as simple as a 5% increase on, let's just say, $16,000 of dividend income, which is kind of the 12-month forward income stream, kind of looking at that portion of the portfolio. Just a 5% increase year over year would be about $800 in terms of increased pay. So you go from $16,000 to $17,000 just by having dividend increases kind of come in. Now, of course, dividend increases aren't always guaranteed. We also had a lot of dividend cuts this year, but this year I would say is kind of it's a one-off year. I mean, they do happen, every 10, 20 years, you'll have something like this where you have some of these big kind of market drops where you do have some dividend cuts kind of come in. But I would say most of the time you would be more so experiencing dividend increases. So while this year I did experience some dividend decreases, I didn't really experience a decrease just based on the fact that I've been consistently adding capital at least twice a month, every month for the past 7 years. So although, yes, I did experience short-term losses on, say, my individual stocks where I'd invested, I made that up and then some with just continuing to invest into the market, which is obviously the goal, right? Then what else would I wanted to say? And then, of course, if you just take that $16,000 and then continue to reinvest that back into the portfolio, that $16,000 is going to buy you an additional, say, dividend yield associated with that. And so let's just take 4% because that's around what the dividend yield of the portfolio is right now. you could say it's going to be another $600 just in that alone. And so from dividend growth of say $800 for, let's just say, a 5% increase year over year, which generally I've experienced 6 to 8% in the past, but I'll take 5% if you say include some of these years where you do end up kind of coming down. But an average of 5%, so that's $800 increase from $16,000 12-month income, and an additional $600 kind of coming from the reinvested aspect of dividends. Even before you even get into 2022, you're looking at something close to $17,500, and that's without any sort of additional capital contributions or anything like that. So that's just the snowballing that begins to start when you go down this sort of path. But what I do want to highlight a little bit, and then I do encourage people to start asking some questions, because that's obviously why I'm doing this, is dividend investing isn't necessarily the best path for everybody. And I think I talk a lot about this a lot of times, but I think a lot of folks really just are looking for specifically what they want to hear and what I'm saying. And so they'll ignore, let's just say 40% or 30% of what I'm saying, and they'll focus on that 60% talking about dividend investing and say, this is what I need to do because this is what Matt is doing. So before we do that, I want to take a quick step back. I started in the oil and gas industry in 2013 timeframe, and very shortly after, in late 2014, early 2015, I started experiencing layoffs, which is a pretty common occurrence in these days in the oil and gas industry. So I experienced layoffs in late 2014, early 2015, late 2015, early 2016 timeframe. So there's two there. We experienced minor in 2018, and now we're going through another layoff or restructuring of the organization again today. And so as someone that is relatively young in their career, it's scary to be thinking about, wow, I'm well paid, but at the same time, this income stream can dry up very quickly. And what I wanted to ensure was, I had enough income where I could kind of I would say it's kind of a high risk job with respect to the volatility of the income stream. So I've been fortunate where I haven't had to rely on this yet, but this income stream can dry up at any moment. And so what I wanted to do was be rather conservative with what I spend my money on and put that away into something that I know is going to be able to provide me an income, say I do lose that stream of income. And so that's why I've been focused on dividend income. Say you have something that's a lot more steady of a job, like let's say you are a teacher, or let's say you are a plumber, or let's just say you have something that's very stable. Maybe you work in the government and you have a very steady job. Then investing in dividend paying stocks may be something that might hinder you, and it might not necessarily be the best line of action for you. And the reason why I'm saying this is because if your main goal is, say, dividend income or something like that, you might be better off just investing in an index fund or a NASDAQ 100 fund for the long term. And then when you need those funds, say dividend income or something like that, you can transition the portfolio later on to be investing in dividend paying stocks. Now, I think what ends up happening is some folks will be like, well, dividend paying stocks, they're generally speaking better performers than non-dividend paying counterparts and yada, yada. But what comes with that is you having to pick the right stocks. And I think a lot of folks always think they are better than they are at picking stocks. But I'll be the first person to say that in my dividend portfolio, I'm for sure have been underperforming the market for the past 7 years, specifically in my dividend portfolio stocks. It hasn't been drastic. I mean, it's been off by 1 or 2%, but just put it in a compound calculator, being off by 1 or 2% in terms of the growth potential that you are then missing out on, the opportunity cost in which you are missing out on by having that 1 or 2% off over 20, 30, 40 years. And you will be amazed at the amount of money and opportunity costs that you have lost because of that. And another thing is, you could be, investing in something where it's a lot easier for you to manage. I think a lot of folks say, hey, I have an hour a week to be able to dedicate to investing in the markets, and then they have 80 stock positions. It's like, how are you supposed to monitor what's going on with 80 stock positions 1 hour a week? that you want to dedicate to investing in the markets. And at that point, if you have 80 stocks, just put your money in the S&P 500. What's going to be, passively managed by the S&P 500 or the Standard & Poor's index that is going to be selecting what companies go in and out, and there's criteria for that. And anyway, I don't want to beat a dead horse, but I notice so many people all the time always wanting to invest in their individual stocks and thinking that they are the next Warren Buffett or the next Ray Dalio or Carl Icahn. And the reality is most of the time you're just not going to be able to do it. And I think a lot of folks will gravitate towards content on YouTube that specifically tailors to that. What stock I need to be the next Amazon, what stock I need to be the next Apple, Tesla, or what stock is going to pay me the best dividends forever, or they just look for the one nugget, when in actuality the best way to do it is to get rich carefully, in my opinion, and especially if you don't have the time to dedicate to it. And I think a lot of you guys that have been listening to the live streams on the other channel, thank you if you have, but I've transitioned more now that I have a decent income stream kind of coming in from that original dividend portfolio that I've set up. I've started venturing more into the ETFs route. So I'm going to give a shout out to my boy GW ETF channel. He's the man. He's the one that kind of turned me on to some of these. But I've kind of gotten to the point where I now put $2,000 away into passive indexes, one of which being the NASDAQ 100 or the QQQ, or some people call it the Qs. I like that one. I think it's good. It might not be great right now, but in the next 10, 20 years, I think it's going to be phenomenal for the long-term growth of the NASDAQ 100. Another one is ITOT, which is an iShares total stock market fund. It invests about 3,600 different stocks. So you have all exposure to the S&P 500, but you also are not limited to the S&P 500 because it also includes some mid-cap stocks, it includes some small-cap stocks, and even some micro-caps as well. And so 3,500 stocks in there, 3,000 of which are not in the S&P 500. And so I think that is rather important for folks to kind of look at in terms of being able to look at that. If you were to compare, say, the total stock market fund versus the S&P 500 fund over the past 10 years, I think actually the S&P 500 wins. But over the long term, you do have some of these you do have some of these small cap companies that come out of nowhere. At one point, Apple was a $2 billion company. Now it's a $2 trillion company. So just kind of keep those in mind when, yes, you might have small allocation to, say, something that could be the next Apple or Amazon, but that, $1 or $2 that you have invested in that could grow substantially over the long term if you have it in, say, a total stock market index fund. And so the group thought about those QQQ and ITOT is, in the future, if I do want to sort of switch over to having strictly just dividend income, I could sell those and buy individual securities with those. But to help with the yield aspect of that, because if you look at ITOT and you look at QQQ, one of which is less than 1% dividend yield, the other is less than 2% dividend yield. And so one of the companies that GW helped with find is actually a NASDAQ 100 based fund that does covered calls. And what I do, and that's called QILD. And what I do is I have about 14% of the portfolio going into that so that I can get a little bit more yield out of the portfolio. So I think the portfolio for that particular one, if it were to be evenly weighted out, it would probably end up being just under 3%, which is pretty good. I would like the portfolio to be yielding anywhere between 2.5% to 3.5% as a whole. The whole dividend portfolio right now yields at about 4.2, 4.3%. And it's come down substantially, especially after some of the dividend cuts from the Wells Fargos, the Shells, the BPs, and say even the Disneys of the world as well. So that's relatively it with respect to where I'm going to now. I'm kind of leaning more towards that. Hey, $2,000, $1,000 every paycheck is going to, that sort of index funds, and whatever I have at the end of the month, I'll probably put towards the normal individual stocks that I pick on a daily basis. And I was joking around with Independent Investor. You know, him and I chat every once in a while off stream, and he was like, "Did I hear you correctly? Are you going to try to lean more towards ETFs?" And I was like, "Yeah. I mean, I got other things going on now. I'm writing options for income. I'm trying to do the websites as well. I'm trying to transition back to the U.S. because currently I'm talking to you guys from Trinidad and Tobago, where I've been living for the past year. So I'll be transferring back to the U.S. here relatively soon, and so, you know, there's other things that I want to kind of concentrate on right now, getting things picked back up in Houston. And so wanting to individually stock pick is something that kind of is somewhat right now falling behind in priority. And I think it will pick back up once things kind of normalize again. But right now, you know, the ETFs aspect of things is good. So ETFs, I think right now are about 4% of the portfolio. I want to get that closer. I still don't know 100% where I want to get it to, but I would like it to get closer to at least 20% for now. And I wouldn't be surprised if in the future it can go all the way up to 40, 50%, just because the simplicity of it, and rather just have that kind of going on with that. And, you know, focus can go elsewhere, whether that's websites, whether that's investing in individual real estate, or whether that's, you know, doing some other things, whether that's tutoring, coaching, speaking, if people really enjoy what I actually have to say and they get value out of it, like the 38 of you guys that are watching right now. But yes, if you guys love the streams and you guys are interested and you guys haven't already checked out our streaming channel, we do streams every Friday night. So there's 38 of you guys. Generally, there's like 50, 60 of you guys that show up in that streaming channel every Friday. So we love doing those. Me and Kyle do them all the time. And anyway, so if you guys are interested, the link's in the description. Just click on that, hit subscribe, and you'll get a notification on Fridays that we're going to be hitting up the stream. So anyway, I am going to start running through some of these questions here. So I'm going to start at the top. So I appreciate all of the 37, 36 of you guys now that are in here. And I'd love to actually start answering some questions. So we can go for as long as you guys ask questions. I'll be here to answer them for you guys. So anyway, shout out to my brother that's also listening from Trinidad. What's up, my man? Make sure to share with your friends. I keep trying to talk to some of my local coworkers that I work with down here, and they're really interested as well in learning to get investing into the markets. And I've been trying to help some of them as well. And a lot of them are learning a good bit. And I'm really excited about that because it's difficult, man. Not every country, and I know Ryan from Independent Investor talks a lot about this as well. Not every country has the opportunity that we do here in Canada, and being an American, you know, in the U.S., have the opportunity to simply open something as simple as a Robinhood account or an M1 Finance account and immediately start investing with relative ease. Some folks, for example, you know, some of the folks here that I work with here in Trinidad, they have to take their Trinidadian dollars. They have to then transfer it to U.S. dollars. They have to go physically into the store to give them the money in U.S. dollars, and then they'll give them the opportunity to fund their account. And then only after they've done all that, they have to do the Forex aspect of things. Then they can invest in individual securities. And not only that, but they have to pay sometimes outrageous fees. Some of the fees that I've heard are $35 US per trade. And it's like, Jesus, what is this, the 1990s? I mean, $35 US per trade is absurd. And especially someone who is just getting started out, it's a huge barrier to entry at that respect. $35 US is, you know, more than most people make in an hour's work. And to be charging someone that, as well as having to do your own Forex exchange and then go physically into the bank, it's just like, I mean, I think we take things for such granted in the US and Canada to be able to have the ease of investing that we do. And so think about some of the other folks that don't have that opportunity. You guys have a phenomenal opportunity. I've been taking advantage of it for 7 years now, and I couldn't be more happy with what's going on and how it's changed not only my mindset, but I guess the opportunities and freedom that I might have to build in the future, just based off of some of the things that I've been able to do over the past 7 years. So how much do I try investing monthly on average? So I don't like answering this question directly Not because I'm afraid of telling you guys what I invest monthly, but because I think some folks might hear the number and get turned off. And so let me explain by that. What I mean by that is it's not necessarily with respect to how much money you're investing monthly. A lot of it, and I get in arguments with Kyle about this a good bit because him and I kind of disagree with respect to this. But a lot of what I think is important is the percentage that you are actually investing of your monthly take-home pay, and not necessarily the exact dollar amount. So when I say I can invest something like $5,000 on a monthly basis, what you guys immediately hear is $5,000. I don't have $5,000 to invest. So why would I even try doing this? Or why would I even try to, and you start talking yourself out of it, and you start putting dampening on your brain and in your mindset, being like, there's absolutely no way I can do something like that. That's absurd. $5,000 is a lot of money. But what I'd rather you hear or say to yourself is let's just say you only have $1,000 to invest and you make $2,000 a month in terms of total gross income. That's 50% of what you're making. If you're able to invest 50% of what you're making, you're going to be able to retire in less than 20 years, right? And so that's what is more important to me, not the total dollar amount, but the actual percentage. If you're only saving 10 to 15% of what you have made on a gross monthly basis, you're going to be working for the next 40 to 50 years. And I'm just going to point that out blankly to you. And that's if you're able to return 6% a year after inflation into the account. You're going to be able to retire after 40 to 50 years if you're only investing 10 to 15%. If you're investing closer to 20%, I think it drops down pretty drastically. And I think if you're saving 30% of your income, you could retire after 15 years or 17 years or something like that. And so it's a really good article written by Mr. Money Mustache. And so it's not my original content there, but it's a really good article that he kind of shows, how quickly you can retire. Obviously, if you're saving 90% of your income, you can retire in about 3-4 years, just based off the fact that you're only using 10% of your income. So let's just say, for example, you make $100,000 a year and you are able to live off only $10,000 of that. Within a few years, you're going to be able to retire because you're only spending $10,000 a year. And so it's a two-sided game, right? It's how much you can save and it's how much you need to spend. I mean, a lot of times we have things that we spend on subscription services or a lot of different things that, sorry about that. Sorry, I had a notification pop up and I was trying to clear it off my phone. So hopefully I wasn't gone for that long. But I would say on average, I would probably be investing close to $5,000 to $6,000 a month. Honestly, that's about how much I would say. And I would say it's about 50% of my income, maybe more, to be honest, because I do save a lot of money working down here and having some of the company pay for some of my expenses. So, I haven't done the exact calculations, but I know for a fact it's relatively easily $5,000 to $6,000 a month, just based on the fact that I'm not spending nearly as much as I was back in the States, and I know how much I'm making. So, but what's most important to me is that I'm saving over 40% of my income, because I think 40% of your income is that kind of sweet spot where you're able to retire very quickly and be able to kind of get that financial freedom aspect of things very quickly, but you're also able to live a good lifestyle, in my opinion, right? So I know it might be difficult for some folks that are making a little bit less, but it is possible. Anyway. So this question is very loaded, right? Because energy stocks is anything from oil and gas to anything with renewable energy sources. And so I think that there's a lot of stipulations to answering this sort of question. If you're looking for oil and gas, it's going to be a different question than if you're looking at renewables or if you're looking at something else. So I would look at yourself and try to understand what exactly you're looking for. Are you looking for a company that is going to be going into renewables and going into that, or are you only looking for something that is an oil and gas? If you're looking for strictly oil and gas, I would say Exxon and Chevron are probably your best bets at the moment, just because they have kind of remained firm. Chevron is doing a little bit more with renewables, But Exxon at the moment, the only thing that they really have for renewables is they have their renewable algae that they kind of use the algae to make oil out of. And so that's really their only renewables business. But if you're looking for something that's going to transition and kind of meet up with the 2050 Paris agreement, or 2015 Paris agreement, sorry, I would say that Shell and BP are well on their way to really changing how they're shaping the energy companies of the world. And not only that, but they're helping the local governments do it as well. So I don't want to talk too much on that with respect to that, but I think it's a lot to do with that. And, you know, I think that it's something that you need to kind of look at over the long term and try to understand, well, do you want to be part of something that's strictly oil and gas, which could be the Chevrons and the Exxons of the world, where they're going to try to maximize efficiency and they're going to try to make sure they increase the margins that they can, lower their lifting costs, be able to make as much margin as they can per barrel? Or are you looking for something that is going to be going into the renewable space? And so I can't answer that strictly with that. I kind of gave you two answers depending on what you're looking for. I think that, a lot of people are saying, Tesla could be a phenomenal company in terms of future for energy and utilities and being solar and all that. But you have to think that some of these oil and gas companies are making massive amounts of cash flow, and you can't discount that. They can scale up things very quickly, especially from a renewable standpoint, and they already are starting to do so. When you look at, say, a Shell or a BP of the world, and the amount that they're growing their renewables portfolio is becoming rather quick. And it's only going to get more accelerated as you go into 2025 and 2030 timeframe. So maybe that's just my bias, because that's the industry I kind of work in, is in oil and gas. And so, but I always consider myself kind of part of the energy industry, which is more important to me. But I don't want to go down that rabbit hole because I feel like that could get me in some trouble if it gets in the wrong hands. So let's click here. So this question is about a little bit about covered calls. So selling covered calls on Caterpillar and some others, how far out do I usually go on the expiration date? And so, yes, I have. For some of you guys that haven't really been following me on the other channel where I do a lot of my live streaming now, because you guys have probably noticed I don't do too much live streaming on this channel anymore. I have been talking a little bit about the covered calls that I've been doing. And it's been about 3-4 months since I've kind of honed into a certain strategy. And so I look anywhere between 7 to 14 days out. And then depending on some of the companies, some of them are only monthly. So like Realty Income is a monthly. A lot of the ETFs that I have are monthlies as well, because I don't own SPY. That's like, sometimes you have a couple in a week, but I mostly do ITOT. I do Caterpillar. Caterpillar has weeklies. So some of the companies that I have weeklies, I'll try my best to do weeklies. Some of the companies that I have only have monthlies, and so I have to do monthlies. So generally speaking, I'll look for 10 to 15% out of the money if it's worth it, right? So sometimes it's a couple pennies per option contract. I'm like, that's not worth it to me. And so, yeah, sometimes I'll just be like, that's just not worth it. So most of the time I go 10 to 15% out. And it's lower premium for sure. But at the same time, unless I really want to get rid of the company, then it's worthwhile for me to kind of hold on to that. And so Caterpillar being one, I think that was a 10-15% out of the money, and that was a 2-week. I think it's $1.50 or $155. So it's actually raised a good bit. So I'm actually like, the opportunity costs, I've lost a little bit on that contract, but obviously it's, I think, at $148 a share. And I think the contract ends this upcoming Friday at $155 a share. So hopefully it doesn't get exercised there. But I have been exercised before. So I had some calls on First Solar, which actually ended up getting executed. And that was in my Roth IRA. And so I took that $5,800 and I bought something else. But of course, you do have lost opportunity cost. And, I did sell it a little early. I think it ended up getting into like the $80 a share range. But, I can't complain because that stock did nothing for me for so long that I was just like, I need to generate some income off of this. And it just happened that happened to be at the time where it just turned around. It was going through a couple of years of restructuring, and I was like, you know what? I have so much other sort of technology plays that I think I would rather have my money in, and that just ended up, kind of being wrong place, wrong time. So didn't lose money on it by any means. I think I got over like a 90% rate of return on that, just on the stock alone. And of course, if you add in some of the covered calls, I think I made a couple dollars here and there. So can't complain because I wasn't, selling it when I was down on the position. I mean, I was already up on the position. So, but this is a phenomenal question. What would you add to a Roth IRA now? For those of you guys that are in a higher tax bracket, I definitely would consider adding, say, REITs into that as well. But also if you have any speculative plays in the future that you might have. So for example, I have a lot of REITs in my Roth IRA. So I have like Main Street Capital, which is a business development company, which I don't think necessarily pays ordinary dividends. I have WP Carey, I have Cyrus One in there. So those are all sort of like business development companies / REITs where I'd have to pay increased taxes on. So an ordinary income tax if I had them in an individual brokerage account. And then I also have Virgin Galactic in there as well as Disney. So companies that I think will have some pretty decent growth in the future, specifically Virgin Galactic. And the reason being is Virgin Galactic pops, it goes up to $300 a share, which I think it might eventually in the 10-year time frame. Then I want to take that money and invest it in something else. But in the meantime, I don't necessarily want to be paying a lot of taxes on the real estate investment trust as well. So that's why I do a lot of that. But I don't necessarily limit REIT investments to to Roth IRA. I have REITs in my individual brokerage account as well. So top SPACs I'm interested in. So the ones that I have actually right now, there's one called IPOB, IPOC. And so that is being led by one of the big Silicon Valley tech gurus. And he basically has, I forget, one of them $750 million, one of them is $250 million, or maybe it's $500 million. And they're kind of allotting it to technology companies, one of which is inside the US, one of which is outside the US. And this guy knows tech, man. So I'm like, you know what, if anybody's going to do well, it's going to be him. And he's going to buy and find something that was really good. So for example, one of the ones that he took public last time was Virgin Galactic, so SPCE. And so, had you invested, at that point and been able to get in on that, you'd be up a pretty substantial amount of money right now. So I just anticipate with technology, this guy knows his technology stocks. He's not going to invest in anything that's, poor. I think that one's going to be good for the long term. As opposed to anything else, I'm not the SPAC guy, man. I mean, I'm just going to be completely blunt with you and not try to be something I'm not. If you're interested, follow my buddy Jason from JMac Investing. He's killer at the SPAC stuff, and he has a lot more information on that. So hopefully you appreciate the transparency. I'm not going to try to be something I'm not and try to talk about something I'm not that great at. But if you are interested, we also do have, I'll share the screen again just quickly. We do have this website where Kyle and I have kind of put together. So we do have some information on here where we talk a little bit about it and ideas as to what you want. So spacstock.com. If you guys are interested in that, you guys could always hit that up and see some of the articles that we have written on here as well. So of course, if you guys are interested, always look at that. That's also something that you could look at, or you could reach out to Jason from JMac Investing as well. So we got Hot GW on there. How you doing, brother? Hope you're doing well. Okay, so what's this one? Any advice on how to be satisfied with the amount you contribute each month? I tend to invest as much as I can, and sometimes at the cost of enjoyment and comfort of your own lifestyle. So I can understand that because I've done that in the past. It's very dependent on you, and I think I've been in this kind of circle on my own, and what I've done is I do a lot of cost benefit analysis, looking at things sometimes. And so I'll be like, you know what? Let's just say, for example, just take my lifestyle, for example. I wanted to drive a decent car. I wanted to uh, have a decent apartment. I wanted to be able to buy nice scotch when I wanted it. I wanted to have some cigars when I wanted them, and not the cheap cigars either. I wanted to buy some nice cigars, right? So I'm not talking, Swisher Sweets or Philly Blunts or anything like that. I'm talking about high quality Dominican or Nicaraguan cigars when I wanted them, sometimes $15 a cigar. And, I don't want to, brag, but I mean, that's just what I enjoy. And then I also want to be able to go out to dinner with friends, hit up the bar sometimes every once in a while to get out of the house. And that sort of lifestyle was costing me probably anywhere between 36 to 48,000 US dollars a year. And so that, of course, was eating out a lot, obviously, and not necessarily buying groceries and stuff like that. And so what I recognized was, okay, so that amount, living off of that, costs me, let's just say, 30 to 40% of my income. What else can I do? And if I say were to start eating at home, how much would I save? And would that be something that I want to do to be able to increase my savings amount? And so even if the answer is that you're really struggling with this, and let's just say you're saving 30% or 40% of your income, I would just look and go to a quick fire calculator, or we have one on the Chartmaster website if you guys are interested, or look at Mr. Money Mustache's kind of chart where you can say, okay, well, I'm saving, let's say 30% of my income, and sometimes I'm struggling to keep my head above water. And me and the missus want to go out to dinner twice a month, and I feel like I can't do that because I'm trying to save this 35% a month. Hey man, just go to the website and be like, look, if I go from 35% from 35% to 30% a month in terms of savings rate, how many years am I going to have to continue working on that? And it could be something as simple as a couple of years, 1 to 2 years. And you're like, you know what? There's so much volatility in the market right now. I'm really not happy with what's going on. And those 2 nights out a week where I can hire a babysitter, get the kids out of my hair, and be able to spend those two nights with the missus twice a month are really going to help things get better, then I would say do it, man. But at the same time, you could also, change some other things within your life. A good example of this, and I'm not going to name names, but they wanted to own everything, and they didn't think about, they were very materialistic, and they didn't necessarily think about absolutely everything, and they really were just buying stuff to buy stuff, and they weren't really thinking about it. And I'm not saying this is you, but something as simple as like having a snowmobile. They didn't want one snowmobile, they wanted 15 snowmobiles. Having a car, they didn't want one car, they wanted 5 cars. And it's like, at some point you kind of have to draw a line in the sand. Like I said, I'm not saying that that's you specifically, but I think that a lot of times people say, well, I need to do this, I need to do that. And it's a lot of societal pressures that force you to do something. So I'll just be very blunt. I mean, I'm 29 years old. I don't have a wife, I don't have a kid or anything like that yet. But everything I have can fit in a 5 foot by 6 foot box, 5 foot by 5 foot by 6 foot. So, that's what I came to Trinidad with. That's all I have. I don't have a car that I can call my own anymore. I don't have an apartment that I can call my own anymore. The only thing I really have to my name that I can kind of say I'm proud of are my laptops, my stock portfolio, and my Rolexes. And that's what matters to me. You know what I mean? And that might not necessarily matter to you. You might have kids, and that could cost a lot more. And I don't have that perspective yet, but I know that kids are expensive. I have my nieces and nephews, and I know how much those fuckers eat. So yeah, just trying to be real. But so yeah, don't hinder your own lifestyle to try to do it. Now, I think you have to be, this is tricky, right? Because you can't take what I say and be like, well, Matt said, X, Y, and Z. I mean, if you're going from 35% to 30% is different than going from 10% to 5%, right? If you're going from 10% to 5%, you need to figure out another way to cut some expenses or get some more income coming in. And that's just the bluntness and the truth of the situation. But if you're trying to go from like 55% to 50%, then I'm like, dude, you know what I mean? Like, enjoy that extra 5%. Go out to dinner twice a month. You know what I mean? Get a hotel room. You know what I mean? And not have to worry about the kids and, you know, stuff like that, right? But I think it just takes a moment to realize what your situation is and be like, yeah, I don't mind going from 55% to 50%. If that means I can have a little bit more fun right now, I would do the same, right? But for me, when I go back to the States, I'm going to try to live off of 40% of what I make. And so the rest of that money, 30 to 40%, I still haven't decided. But I think that, you know, the rest of that money is going to go to either paying taxes or to the investment accounts. Yeah, anyway, hopefully that's as much perspective and enough, you know, kind of talking about it without knowing your exact situation going on. Hopefully that was a different way, and hopefully a lot of people can kind of get a different idea as to how that topic can relate to them. Hey man, I mean, so the question is, do you think 30% of one stock is too much, specifically Microsoft? I would say so from my personal perspective, right? So my personal perspective, yes. But I am someone that, generally speaking, doesn't like to have more than 5% of my money in one individual stock. That's just me. And so, I mean, it could be that you are high risk, high reward kind of guy, and you don't mind waiting on that. But, you know, you could take some money off the table and, you know, depending on what kind of account it's in, if it's in a Roth IRA or something like that, you could sell it tax free and say, you know, I'm going to sell half of this Microsoft and I'm going to put the rest of it in QQQ or something like that. And not to say that QQQ is going to outperform Microsoft in the next 2 years or something like that. But I would say it might help just relieve some stress for you. And so I think it's very dependent on what you feel, right? I mean, are you comfortable with having 30% of your portfolio in Microsoft? You know, it doesn't mean you have to go from 30% to 10%. Doesn't mean you have to go from 30% to 5%. It could just be, you know, you go from 30% to 25%, take that other 5% and toss it in something that, you know, you've also wanted to invest in for quite some time, or you think it's out of favor right now. And so for me personally, having 30% of my one stock is too much. Just based on my portfolio is $540,000 though. So that would be a lot of money. That'd be over $150,000 in one position, which I would be uncomfortable with. You know, you could just be starting out. And if you're just kind of starting out, then it's very different, right? You have $1,000 portfolio that you've kind of built up over the past 6 months, you know, then that's a little bit different than, you know, someone that's been building it for 7 years. So it's all dependent on what your perspective is. A good source to find stocks that pay dividends. So this might seem like a pretty rude answer, but I mean, you can try to find a whole bunch of different news sources like Seeking Alpha, Yahoo Finance, and stuff like that. But I think at the end of the day, what you just have to look for is looking at the financials yourself and saying, does this company have the ability to keep paying this dividend? And what's their revenue stream kind of looking like? And what are they generally doing in the pipeline that's going to continue to increase this revenue stream and thus be able to increase the free cash flow coming per share? And so, you know, that requires some due diligence to have the best and utmost confidence in the companies that you are investing in. And I think, to be 100% fair, a lot of people don't want to put in that due diligence. They just want to find a website or a source. And I'm not trying to be little your question here, but they just want to find a source that will give them, hey, this is the best companies to do so. And that you might have a source, but it might cost you some money to do that. I think the best way and easiest way is to really do it on your own, because nobody knows what your investing objectives and time horizon and risk tolerance and your financial situation is better than you. And so if you kind of learn a little bit about how to find those kind of companies, then the best person to answer those questions is you. And so, yeah, that's just kind of my thought process. And that might not be the answer you expect, but that's the answer that, I'm kind of helping in providing. And a lot of people get very upset about that because they think that there's a one-size-fits-all strategy for the market. And if there was, everyone would be millionaires. The secret would have already been out. But it's the variability and the volatility of the markets and the different objectives of people that continue to keep the game alive. And that is what it is, in my opinion. So I think I answered this one a little bit already. Did I go up again in questions? Anyway, sorry about that. Yes, I would agree with Jerry on this one, trying to understand what specifically your expenses are and why you need them. And that might be able to cut. And I think what Jerry's referring to is when I was kind of talking about how investing in retirement and financial independence is kind of a two-way journey. It's not only how much you're going to be able to bring in, but it's also your expenses. Do you really need to have 2 brand new cars, or can you have 1 new car and one of you guys can drive, well, I'll call it a beater, but it might not necessarily be a beater. It might just be something that you buy in cash. And now you don't necessarily have to have that monthly expense kind of coming in. So that's up to you, my friend. I personally am someone that always invests in the stock market. I have a different view than most people. I think that the stock market, over the long term is going to go up and to the right. I don't need the money right now. I think that, I might need the money in, say, 10, 20, 30 years. But my thought is that even if I do need the money in 10, 20, 30 years, I'm still going to be investing in the stock market. I think that, buying equities is probably the best way to generate wealth. In my opinion, it's the most liquid way, and it's the easiest way to move money. If I need cash today, I can go to my accounts and sell them and take that money out within a couple days. Whereas if you have real estate, it's very illiquid. You might have to have the market on the house on the market for a week, 2 weeks, 6 months. And there's nothing wrong with that. It still provides cash flow. I still think it's a valuable thing, but I'm not here to try to time the market. I've tried that before in 2015, thinking that the markets were overvalued and there was going to be a correction at any moment. And I missed out on, a couple dozen percent of the market going up and to the right. And so, had I waited another 5 years, I would have lost even more money. And so I don't fight with what the market's going to be doing up, down, sideways, today, tomorrow, in 2 months when election is going on. I personally just look at the fact that I think that markets are going up and to the right. I believe in the U.S. economy. I believe in the work ethic and the technologies and the industries that we have built within the U.S. And I think it's been great for the past 200 years. I think it'll be great for the next 200 as well. And so that's where I'm betting. I'm not betting on the next 2-3 years or next 2-3 months when elections are happening. But I mean, of course, it's also very dependent on what you need that money for. If you need that money in the next year, then sure. I mean, it might probably be better for you to kind of hang out a little bit on the sidelines. But I'm speaking from my perspective, which is someone that even if they have financial independence, are going to continue to probably invest in the stock market. Any additional money that I have is going to probably go into the stock market over the long term. So yeah. My boy, Hot Dave, as always. Yeah, long time no solo stream, so I figured I'd give it a go. Hope you are doing well, Miss Allgood. Can't wait to hang out with you in Houston soon enough. How many positions am I looking to consolidate or reduce? I don't necessarily know. Very dependent. So there is 2-3 companies that, depending on what happens with them over the next couple months, I might just get rid of them. They're kind of, I don't want to say dead positions right now, but there are some that like I've gone down 99%, like my Cedral partners, and I should just get rid of at this point because I don't know if they'll ever come back, and if they do, will it ever be to the extent where but at the same time, it's like $60 of an investment now, whereas it was about $2,500 before when I first got it on. But anyway, that is what it is. And then there's IPOB and IPOC. If those don't really announce anything in the next 6 months or so, I'll probably trim those. So that's 3 positions right there. CQP, I do like that as a company, and I would hold that if I didn't have as many positions. But CQP, which is Cheniere Energy Partners, I think is something where I would want to potentially consolidate. So I did have Phillips 66 and I had CQP, and so I think it might just be worthwhile to consolidate a little bit more in my individual brokerage account. And another thing is with this though, is I have a lot of, I have sometimes the same stock in multiple accounts as well. So like Johnson & Johnson, I have in 2 accounts, 3M, I have in 2 accounts, Visa, I have in 2 accounts, Realty Income Corp, I have in 2 accounts, Main Street Capital, I have in 2 accounts. And so that's something where I might as well consolidate as well. So even though I might have 2 different positions in it, it's the same company. Not necessarily sure why I need to have it in 2 accounts unless it's specifically for tax purposes, which most of the time in the Roth IRA it is. So let's see. Any advice on making more money? Yeah, put a lot of effort in and really try your best in thinking about what value you can provide to the marketplace. So it's not necessarily about the money that comes in, but the value that you bring to the community. And if people don't get any value out of what you're doing, you're obviously not going to get any monetary money kind of coming back into your pockets. And so a lot of the excess money that I've been able to make besides dividend income is through YouTube. And that's obviously, talking to you guys, putting out value. You guys are obviously getting value out of this stream right now. You guys obviously get value out of the videos that I put out. And so that gives me a little bit of money every month. And then also putting together a portfolio tracker. So, putting together a spreadsheet isn't too difficult for me, but it does require a little bit of time and effort. And it would be easy for someone like me who's an engineer and deals with Microsoft Excel all the time or Google spreadsheets all the time. But for somebody like yourself, who might not necessarily know how to use spreadsheets all too well, it's difficult. And so that me able to provide that service is something that, can easily help people in the long run. Or even Kyle. Kyle does a really good job. Kyle from Passive Income Investor, he does a really good job with the websites. And so him putting together websites, obviously that's a service that not everyone can do. And so, him being able to do that is really an opportunity for him to kind of bring value to people, whether they want to hire him for specific services and build a website for them, or to consult for them. Or in my case, he's the one that kind of handles the website aspect of our business, and I kind of handle the tools and some of the publicity and not publicity, but the marketing through my YouTube channel and just my portfolio and people being interested in seeing that. So hopefully that helps. But I mean, a lot of good stuff can kind of come through this. I mean, I can get really specific about some good people that you can kind of listen to really change. So I think specifically one that I really like that has really started to change my kind of mindset and understand that the only difference between you making, let's just say $10,000 a month and $20,000 a month is yourself and you kind of having that sort of work drive and working smarter and not harder, and changing how you show up in a meeting and changing how you present and changing a lot of things about yourself to make you more valuable to the marketplace. And a really good person that you can listen to about this is Tony Robbins is a good one, but he had a mentor called Jim Rohn, and there's one particular talk that Jim Rohn gave in like 1983. And so if you just look it up, it's probably on YouTube. It's how I stumbled across it. And one of the key things that he talked about, I'll say two things for this, and hopefully it helps you out and hopefully it inspires you to go listen to Jim Rohn, because I've listened to him a good bit over the past 2 years since I kind of found him, is the I'm trying to remember the exact quote, so I apologize. The one I do remember is, if somebody hands you $1 million, best you become a millionaire quickly, so you get to keep the money. And the reason for that being is, if somebody hands you $1 million and you don't have a millionaire mindset, you're going to lose the money because you're going to go spend it on a Lamborghini, you're going to spend it on a house, and boom, you spend it on a Lamborghini, spend it on a house, immediately you're not going to be a millionaire anymore, right? But if you have a millionaire sort of mindset, you're like, shit, somebody gave me $1 million, I'm going to invest this. This is 30 grand a year, 40 grand a year that I don't need to work for anymore. And I can turn this $1 million into, 1.5 or $2 million over the course of the next 10, 20 years, and get that $30,000, $40,000 passive income drip kind of coming through. Or you invested in a business or something like that allows you to make more money and add more value into the marketplace. So of course, that's a really good quote as well. And I think the other quote, I'm going to probably butcher it, so I apologize this, but the biggest, how do I say it? The biggest obstacle between you and your better future is you. And I think that I messed up the quote there, so I apologize. But basically what he's talking about is, a lot of times the biggest enemy that we have in front of ourselves is standing across from the mirror for us every single morning, every single time we look at lunch, every time we go to the bathroom and wash our hands. That's your biggest enemy. And this happens to me all the time. I have a lot of self-limiting beliefs that, even though I've been able to accomplish what I've been able to accomplish, sometimes I'll sit and talk to myself and be like, I can't do this, or I can't do that, or, I think negatively upon myself for self-esteem problems. And, a lot of people have that sort of problem. They might say, oh, my nose is too big, or I have like weird looking feet, so I can't do this, or I can't do that. And a lot of that really impacts us, not only from like a self-esteem standpoint, but also your day-to-day life and the way you show up every day when you go to a meeting, and when you show up to go to shake someone's hand or anything like that. And so all those small things really add up over time. And in order to kind of make sure that you're showing up as the best as you can, you have to change who you are. So if, let's just say you're making $50,000 a year and you don't like who you are, you have to change who you are. You have to go and figure out a way how to get that $50,000 a year to $100,000 a year. And it's not necessarily always monetary that sort of impact is. It also has a lot to do with, how you show up on a personal level. Do you have good business relationships? Do you have good family relationships? All those things, while, might not necessarily seem like what pays into making more money, all eventually become, things that are important. And I think that what you can always see is these billionaires and millionaires and stuff like that, they're all very charismatic, genuine, great people most of the time, right? So there are, your bad actors where, of course you meet them and you're like, that guy was a jerk. But, you meet the Bill Gates of the world, you meet the Elon Musk of the world, and you're like, these are larger than life characters. And you're like, well, how did they become, X, Y, and Z? And it's because they continue to work on themselves, and they continue to change themselves every day, get better on themselves every single day to be who they eventually have become. And I think that is a huge part into what it is. I've had a lot of people, kind of give me small bits of feedback here and there throughout my working career and also my investing career. And a lot of these people are my friends that I deal with, Ryan or Dave or Jerry from YouTube here, or even some of my coworkers that I have. They'll say, I'll ask for feedback. I'll give a presentation and I'll say, I feel like I didn't do well. I feel like I didn't show up in that meeting as I wanted to. Do you have any feedback? And they'll say, well, I think you did well in these 3 areas, but the thing that I think may have confused folks is X, Y, and Z, or you may have said something that was counterproductive and kind of went against what you had said a second before. And so with that, I kind of take that away and say, well, how can I improve my articulation in some of those meetings where it's more powerful? How can I remove some of that color language, like like and probably and should, or not should, but likely, or and utilize things like that have more certainty or more concrete, and don't dilute the message and come across as less effective. So things like just say like, oh well, I'm only just or only doing X, Y, or Z, and it's like, well, you're kind of downplaying your own impacts. And this is something that Gen X Dividend Investor has mentioned to me as well, is that I do a lot of self deprecating humor where I kind of attack my own self, and a lot of that has to do with the fact that I'm kind of comfortable in my own skin, but at the same time, it might take someone else that's kind of looking out from an outsider's perspective, kind of coming into my life and saying, well, if this guy doesn't like this about himself, why should I like it about him? And it kind of lowers the amount of integrity or the value of the message that I might be coming out of my mouth. So anyway, hopefully that was a help. That's not necessarily going to say invest in this stock or invest in that stock, which is what you were looking for, I'm sure. But hopefully it gives you more of a life lesson journey that, you have to consistently be learning. And a thirst for learning is something that is really going to be a huge change on how you come up and show up every single day to work, and how you can do things better. And eventually that might show up as adding more value to the marketplace, which then shows up as you getting more money in your pocket. I do not know anything about Dynacert, so I will skip that question. Yeah, not yet. Technically, I'm still kind of in between weird schedules, right? So I'm like still working Trinidad, and I'm still working U.S. stuff. So I'm like, do I take off today? I had a lot of work that I had done earlier this morning, so I finished a lot of that off, and I'm like, I'm still somewhat like, I don't necessarily know if I'm supposed to be taking off today. I didn't. Last week was Labor Day holiday for Trinidad, and I was working because I had to meet a deadline. So it's like, I'm kind of didn't take off last Monday, which I was supposed to, and I should be working right now, but I'm kind of taking it easy, answering emails here and there. But anyway, might have said too much on that one. But after about 4 o'clock, I'll probably get into the good drink and cigar. But I finished all my gin, and I bought a bottle of rum that it was a $50 bottle of rum, so I was expecting it to be pretty damn good. Here I am. I bought Angostura rum, and I thought, every single bottle of Angostura that I bought was really good. And here I bought this 15-year-old aged rum, and I'm like, this is not good whatsoever. So let's see what else we got here. Do I max out my 401k? No, I do not. So I want to talk about this a good bit. And, and I want to highlight why it would be beneficial for you to max out your 401k, why not it might be beneficial for you to do that. And so for me, I do not max out my 401k. And a lot of folks might be like, oh my God, that's sacrilegious. I've been yelled at by my friends that say I'm an idiot. I've been yelled at by my friends saying that, I'm making dumb financial decisions, and I consider myself someone that's helping to coach others on their financial decisions. Why am I steering people in the wrong direction? Anyway, I don't invest all and max out my 401k because I plan on retiring way before 59 and a half years old. And so I don't want to have my money locked up in a 401k that really does not allow me to have the flexibility and optionality of being able to do what I want when I want. And so I would much rather pay taxes on some of this money now to have that money available to me so that I can retire and do with what I want when I want, rather than having to wait until 59 and a half or pay a penalty to be able to access my money. Now, what I will say is I do match up the company match. And I do say that the company 401k that we have is very flexible. So I can do rollover IRAs whenever I want. I don't have to leave the company or anything like that in order to be able to do so. And so that's very beneficial as well. And Yeah, so I get my 401k match, I match up to that, and then the rest of that money goes into an individual brokerage account or a Roth IRA. And so that might be helpful for you. What I think is beneficial for folks that are hearing this message and saying, well, shit, Matt, doesn't max out his 401k, why should I? And the reason why I think you might want to is especially if someone, let's just say you are just getting into the workforce, 20, maybe even 30 years old, and you are only contributing 10 to 15% of your income into your 401k. That means you're going to probably be working until you're 60 years old. So unless you change how you are investing your money, or unless you change your contribution rate, you'll be working until you're at least 60 years old. And of course, if you're investing way less than 20% of your income, you're investing way less than 30% of your income, then I would recommend that you probably look at your 401k and say, this is probably the best and most tax efficient way that I can make sure I get as much money as I can into some retirement fund so that I can eventually retire. Someone like myself, who is now saving way over 50% of their income, and will probably contribute closer to 30 to 40% of their income in over the next couple of years, when I kind of go back to the States and have to start picking up more expenses again. I could honestly retire now if I wanted to and go to most countries around the world. I could live in South America, I could live in Southeast Asia relatively well and not have any problems. And I wouldn't be able to do that right now if I had all my money tied up in a 401k. And so I think that's all very dependent on what your situation is. Now, of course, what am I trying to say here? Of course, you can put all your money in a 401k and pay the penalties and the taxes associated with it if you wanted to. But I think that for me, I'd rather have the liquidity of being able to take that money out, invest it in real estate if I wanted to, invest in options, or take that money, sell it, and let's say go buy a website or invest it in another business or what have you. And I think that the optionality of that is beneficial to me. And I know you can do that with Roth IRAs. If you have a self-directed IRA, you can start doing some of those things as well. But I would just rather have that money be able to be in my hands and utilize it whenever I want. And so that means, getting my match, my company match, which I'm fortunate to have, and then just investing the rest into an IRA and an individual brokerage account. And I don't want to max out my 401k because I feel like, that's an emergency fund for me. The way I look at it is, just to be very blunt with you guys, I do a 7% and I get a 7% match. So to me, that is my fallback. So 7% plus 7% is 14%. And so most of the time people recommend saving 10 to 15%. Financial advisors recommend that. I think that's too low. But for me, while I'm working, I'm doing that 14%. And so if by chance I had to work for the next 30, 40 years, I would have that 7% match. And I would have that sort of, retirement fund where, if you're investing 10 to 15%, you're going to have to work for 40 years of your life to be able to retire. And so boom, that's kind of my 14%, gets me to that 40 years. And, if that's the case, then I have an excess retirement that I can then tap and use if I then, I'm 59 and a half and I have the ability to do that. But I just have so much money outside of my 401k at this point, $540,000 at 29 years old, that I can use to buy whatever, and generate whatever income that I want. And I'd rather have that flexibility than having it in a 401k. And so sometimes I think a lot of folks, and this could be you, it could not be. And so I apologize if I'm speaking out of turn. And this isn't necessarily directed to you, Sajan. So, or Sajan, I apologize if I'm messing up your name there. But I think a lot of folks will invest scared because they're afraid to pay taxes. And, if you're paying taxes, it's because you're doing something right. I mean, I'm not pro-tax by any means. I'm generally speaking, I would rather pay less in taxes. I think a lot of us would. But I think a lot of folks will avoid doing something because they had to pay a 15% tax when you're walking away with 85% of the earnings on that. And so just think about it that way. I think a lot of folks will be like, I'm not going to do that. I have to pay so much more in taxes. It's like, dude, like you're walking away with X, Y, and Z. Yeah, you might have to pay $1,500 in taxes, but you're walking away with $8,500 in gains. I mean, it's a no-brainer at that point. But I think people get so brain fogged by taxes that it hinders their performance sometimes. Probably how much do I make on selling portfolio spreadsheets? Probably about $1 billion. And I just don't show you guys that. But in actuality, it's like $400 a month, $500 a month that I'm making, and it requires some upkeep sometimes and changing out the formulas sometimes, and sometimes the websites change their HTML code, and sometimes you have to bug people and get some people to help you out in order to figure out how to read it. And but the thing that I hope is happening the best is when I really started making this tracker is how I really started managing the portfolio like a portfolio of different companies, different sectors, different stocks. And so it really changed the way that I invest. I started making this portfolio tracker in Excel probably like 5-6 years ago. And it was a lot manual, very tedious process. And, over the past 2 years, I've kind of transitioned it to be something that's a little bit more automated. And the thing that I did recognize most was the amount of money I was investing in oil and gas companies, because I invest in mostly in oil and gas companies. But that was kind of counterintuitive, right? Because if I lost my job, it's probably because the oil and gas industry wasn't doing well. And here I am investing most of my capital into oil and gas companies. And so I was like, shit. I mean, at one point I had over 40% of my capital in my portfolio attributed to oil and gas companies. And I was like, well, shit. I mean, of course, some of that has to do with the fact that a lot of these oil and gas companies are down in price right now, but it's way below 15% of the portfolio now. A lot of which has to do with the fact that, the value of those stocks have gone down, but a lot of it also is because I've started investing in a lot of other things besides oil and gas. Most specifically, I put a huge effort in investing in industrials, which before I think was one of my lowest sectors. And I was like, well, shit. I mean, there's a lot of great industrials companies, Caterpillar, 3M, Boeing. I don't know why I'm not investing in these companies, so I need to. And so I don't necessarily look at it as really selling it to make money. I'm doing it to help provide people the same visualizations that I had to be able to make the decisions that I did, and really stop looking at it in terms of an income stream, but rather a way to help people take hold of their own finances and understand shit. I mean, I have 30% of my money in, financial companies, or I have 50% of my money in technology companies. And it's not necessarily saying that that's a bad thing. It's just allowing people to have the visualization that they need to make the decisions that they need. Maybe they didn't recognize that they had 50% of their money in technology companies, and they're like, whoa, my risk tolerance is, relatively small. Having 50% in one sector is kind of tough. I don't know if I can do that. And that's more so what I want to bring to the marketplace, is those sorts of tools, which I think are somewhat lacking right now. I know there's some other good quality tools out there as well, but that's the hope is that folks get that. And we think that there's the good value, and that's why people continue to buy it. So if you guys are interested, just go to the chartmaster.com, which I think is this website here, chartmaster.com. And yeah, hopefully you guys are interested. I prefer the Google spreadsheet one. That's the one I utilize. So if you guys are interested, one-time fee, once you buy it, it is what it is, and you guys will be all set up for that. And some folks are charging monthly fees, which I don't have any problem with that, but I prefer the one-time fee. I don't want to rake you guys over the coals, but I think that is a relatively good product, and we updated recently. We did a big update in July, and we did some minor updates here earlier in August. And so, yeah, anyway. How would you prioritize paying extra on a mortgage versus investing more into the market? My mortgage is 2.75% on a 30-year note. So, I mean, 2.75%, in my opinion, is basically free money. I know a lot of people see the interest and they're like, oh my God, if I just pay an extra, and there's no right or wrong answer to do this. You're asking the question because you already have an opinion, and you're just looking for either verification or you're looking for a really good reason as to why to change it. I think that personally, I would put my money in the market, especially if your mortgage payment is relatively low. I have a lot of friends and family that would be in the same situation that you are, and they're putting money into something that might go up 2% a year. So think about it. If you have a 2.75% loan on this property, 30 years, and it's only going to go up in value, say 2% a year. Let's just say you paid out all outright, right? Now you have, let's just say, a $300,000 house that's going to go up 2% a year, so $6,000 a year, $6,000 a year, which is great, right? That's commendable. It's something that you can do, or you can invest in something that, let's just say, on a yearly basis, get you anywhere between 7 to 10% before inflation, right? So maybe 5 to 7%, maybe 5 to 8% after inflation. Why wouldn't you want to put that extra money in something that would be able to get you more money in the long run and potentially give you a little bit more flexibility on things? So, you could do multitude of things, but I think you might already have your opinion as to what you want to do. But I personally will probably be doing the 2 point. I would probably be investing strictly in a stock portfolio or an index fund rather than paying down a 2.75% mortgage. But that's just me. So let's just see. Yeah, so that's a really good point. All good. A lot of people work on themselves constantly, and they bring value to the marketplace, and the money comes as a side effect. And Elon Musk isn't in the market to be able to change. Elon Musk isn't in the marketplace working on Tesla and SpaceX because he wants to make money. He wants it because he wants to go to Mars. And so the money that comes with that is associated with the value that people are then saying he's going to be able to, put a man on Mars, and that's why he's getting the money, not because he wants the money. I mean, he has literally given so much money to keep Tesla from out of bankruptcy in its early years that he almost himself went bankrupt, and that's why he owns so much of the company. But anyway, same with Jeff Bezos, right? I mean, he doesn't necessarily care about the money because all of his money is tied up in his Amazon stock. I mean, he very rarely has any sort of other investments. And I think I just checked, and it was like all his money is in 17%, owning 17% of Amazon stock or something like that. And I'm like, Jesus. I mean, at that point, it's like, sell some off and do this and that. And at this, I think there was an interview where he was like a billionaire, and he was driving around like an old 4 or 5 year old used Honda Accord, and here he is like worth several $1 billion at this point. And it's like, to them, it's not necessarily about the money. It's being able to change the way that people buy things. It's being able to change the world, putting a man on Mars, because if we don't, somebody else will. That's the things that kind of keeps them going. And with that comes, the cash inflow. And that's what I'm trying to do. I'm trying to change the way that people invest. I'm trying to help the way that people invest. And through that, money will eventually come. But that's just me. Yes. Buying a GTR is a thought. I have thought about that. Sorry. Yeah, GTR or a Tesla. Exactly. Let's see. So Starbucks, they have a decent amount of cash flow. So they have the ability to pay the dividend. It's just, I don't know. But anyway, I don't know much about Leggett and Platt. And to be honest, the thing about Starbucks is it's so saturated, and I feel like there's other companies kind of coming into the marketplace that will try to hinder its performance in the long run. So that's just me. I have looked at LAND in the past, but I haven't looked at it in a couple years. Barney, I have a question for you. What is your favorite dividend stock or favorite stock as a whole? I'll leave it there. Let's see, a lot of discussion about. Okay, this is a good question. So what's my reasoning for choosing ITOT? You're invested in that ETF. We would like to hear my rationale. Also, have you shifted? Yes. So I talked a little bit about this earlier on in the stream. So apologies if you weren't able to make that. But I like ITOT because it's a total stock market fund. And I would say that VTI is also a good one. So Vanguard is the one that does VTI. And iShares is the one that does ITOT. And I think the reason why I gave a little bit of my rationale as to going from individual stock investing into ETFs, which I think most people should look at, mostly ETFs, unless they are in a very similar situation to me, is I work in a very volatile industry that has gone through about 3 to 4 layoffs since I started in 2013 timeframe. And so with that, I wanted to make sure I had dividend income. And so I was looking at a lot of dividend income paying stocks, because I was afraid at any moment I'd lose my job. It allowed me the flexibility to say go to a different country to live, or at least supplement my income if I were to say have to go work at, sort of an entry level job, like working at, say, a Costco or, a McDonald's or something like that, where I'd be able to still make money, but then kind of supplement my income by working, and getting that sort of extra income from my dividend portfolio while I look for another job as an engineer or something like that. But now that I'm making enough money kind of coming from those dividends and my website income and options income, I've now got to the point where I'm saying, you know what, it's easier for me and my time is more valuable spent trying to come up with bigger business ideas that are going to make me more money in the future and add more value to the world and more value to the marketplace than me spending my time on investing in individual stocks. And so I still love investing in individual stocks, but I think that in the long run, growth is a bigger part of what I need to do now, and investing in that rather than specifically looking at dividend paying stocks. And that allows me and affords me more time and allows me to kind of accumulate more capital faster, which will allow me to hopefully in the future do some more about what I want to do, whether that's investing in businesses, physical real estate, or something of the like in the future. And so the dividend aspect of the portfolio is really just to make sure I don't end up on the street somewhere, or begging to go move in with Dave from Hidden Freedom Investing, because all he has to eat in his house is bacon. And I love bacon, but sometimes you need to eat a damn steak, But anyway, all jokes aside, so that's the reason why I've kind of gone from individual stocks more towards ETFs. And, I'm not saying I'm against either one, but I think a lot of it is folks wanting to outperform the market, but they don't have the time to dedicate, and they think that they're the next Warren Buffett. And so anyway, hopefully that was helpful for you guys. I think that was close to being it. So I did get a call on my work computer just a moment ago. And so let me see if there's any final questions, and I will maybe answer one or two more, and then I will have to sign off for you guys. If you guys, please, there's 57 of you guys. I'd really, really appreciate if you guys took a moment to go over to our other website, YouTube channel, where we do a lot of our live streams. So me and Kyle from Passive Income Investor, you guys might be like, wow, this is the first stream Matt's done in a while. I actually did 2 streams Friday night, 3-4 days ago. And you guys probably didn't even notice because you're not following the right channels. So, I'm not trying to say, go do it because I want you to. And, you know, if you guys enjoyed this stream, you know, 60 of you guys came in and out at this point and been watching, and I appreciate that. If you guys are interested in seeing more streams, you know, make sure you go check out the Passive Income Educator YouTube channel and, you know, subscribe to that. And let's see if anybody has, or if I'm kind of just talking to myself. So 2 of you guys have, so I appreciate that over the past couple hours. So if you guys could do that, that would mean a lot. You guys can see we've been kind of churning out live streams for the past couple weeks now. You know, we're getting 300, 400, up to 600 views every few weeks now. So we just did this one on Friday, and we were able to get, you know, about 414 views. So that means a lot for you, from us, to really get this channel up to 1,000 subscribers, so we can really start to add a little bit more, I guess, emphasis into the channel and the secondary channel as well. So you won't only just hear from me, but you hear from Kyle from Passive Income Investors. So if you're interested in websites and a bunch of other things as well, make sure to look at that. And of course, yes, we have the Chart Master. So if you guys are interested in tracking your stuff there, feel free to do so. If you guys want to support the channel as well, we have the Passive Income Educator membership. We have lifetime membership. We also have the 3-month membership. And if you guys aren't interested in that, we have individual courses or one-on-one tutoring sessions as well. So if you guys are interested in that, feel free to check that out. And if you guys are interested in SPAC stocks, we have SPACstocks.com for you guys to check out as well, where we talk a little bit about SPACs. So enough from me about that. So let me hop over to here and really just do a sign off. So really appreciate everybody stopping by with this particular stream. I know I don't generally do the streams here on Map Money anymore. And I noticed that a lot of you guys really didn't like it. And some of you guys were actually unsubscribing a lot more frequently, just based off the fact that there's a lot of alerts when you kind of do live streams. And so I was having a lot of problems growing the channel because a lot of folks, I think, really didn't like the live stream alerts. And so if you guys are interested, go over to the new channel. That's where we do a lot of our live streaming now. But really just wanted to check in with you guys and see how everyone is doing. It's a nice, beautiful day out here in Trinidad and Tobago. So I think I might go hang out by the pool after I find out if I have to go answer some work emails or something like that. But really appreciate that. We gave you guys a brief overview. We went on everything from, you know, where I'm going with respect to the ETFs and growing the ETF aspect of the portfolio. We've talked about how much the portfolio is generating in 12-month income, forward 12-month income, how the compounding effect is really starting to play into it as well. We talked a little bit about 2021 goals, talking about how we're supposed to make $21,000 in dividend income in 2021. Hopefully break $30,000 in total income. That would be cool. That would be really cool. Breaking $35,000 in total income in 2021 from different passive sources as well. So trying to think if there's anything else. Hopefully some of those questions are really helpful for you guys. And I'll talk to you guys on the next stream, or see you guys this upcoming Friday on the Passive Income Educator channel. All right. Cheers. See you guys next time. Peace.